Hey, John, very good to see you. I know that you have been very busy working on the topic that we're talking about today, which is the 60/40 portfolio still relevant? You know, it's been a bedrock of long term investing for the longest time, and it posted its worst monthly slide since early in the pandemic. Normally, it would see an annualized return of about 10%. So, how confident are you right now in the 60/40 portfolio?
Yeah, so Aaron, the 60/40 portfolio has been a bedrock for a
Right.
very long time. And it was a very bad month, just not only for the 60/40, but for all the
Yeah.
market indices. And the 60/40 portfolio, I think the best thing is, I've seen articles saying, is it dead? But I think right now you just have to look at the sign of the times. And I think the 60/40 portfolio needs some tweak in it. And we skipped our last video session because that's what we were doing. We were going through all of our clients' accounts and
Right.
really rebalancing, not on the focus of what the volatility that happened in January. We knew volatility was going to come, but really preparing for the Fed's
Right.
interest rate hikes, which, if you have the 40% bond portfolio, is going to hurt bonds, especially long-term bonds.
Right.
So, that's what we are doing. And, we don't try to pick the winners, right? We're
Mhm.
not Brookstone, Securus Financial. We're not into saying this is the next hot, stock tip. We're
Right.
into preserving and safely growing our clients' money. So here's the dilemma for retirees with the 60/40. The 40% is really, really needed for retirees and pre-retirees. You need that risk diversification, and
Right.
bonds have always been the traditional way for an investment to reduce risk. You can't have an all equity portfolio and be retired and not expect to have a large amount of market loss during a correction. The other thing that bonds have always been used for is predictable income streams through bond ladders. So right now, that's a challenging time.
Right. All right. Well, we're going to get to maybe some other options in a second, but first I want to ask you about what you just hit on, which is the Fed raising rates. Of course, that could happen any moment, and we don't know how often it's going to happen this year, but how will the Fed raising rates change what we're seeing right now with bonds?
Yeah, so bonds, I always use a teeter-totter example that on the left you have price and on the right you have interest rates. So if you buy something and the interest rates go up, the price of your bond is going to go down, because in the future, if that bond pays out more and you need to liquidate your old bond that pays out less, well, then you're going to have to sell it at a discount. And that's why for the last couple of years, a lot of bond experts have been saying that we're coming to the end of that 30-year bond bubble where we had these real high interest paying bonds in a shrinking environment. So to the opposite of my example, when the interest rates went down, your bond value went up. So,
Mhm.
bonds are going to face a lot of interest rate risk, and a risk known as duration risk. So the
Mhm.
longer you have a bond, like a 20-year bond, is really going to have a lot of volatility. BlackRock and Brookstone had already taken some preemptive measures to go to shorter term bonds. But especially with this last allocation, we really hit models that had exposure to longer term bonds and got rid of those models for now.
Right. Okay. So let's talk a little bit more about those models because I know, first of all, you specialize in helping retirees and pre retirees navigate all this uncertainty. So, what are you recommending to clients right now who want a successful, but, risk appropriate portfolio?
Right. So, our point of view was we are reducing bond exposure. We went to shorter term bonds to reduce that duration risk we talked about. But then
Hmm.
we also went to a lot of more advanced institutional strategies. And sorry, do it yourself investors, you may not have access to all of these. So I
Right.
apologize for that. But, we're really looking at three, four major areas for clients. Number one, it's structured or flash notes that we negotiate with banks that have no bond exposure, but they have some downside risk protection. We're looking at hedged equity, and we mentioned this, in past
Right.
past things where we're essentially hedging some downside risk while keeping an all equity holding. And then the last is, Brookstone really embraced this and has come out with some new models that are called defined income or buffered ETFs, which are
Right.
similar to the hedged equity, that they have some downside risk protection based on certain levels of how aggressive our clients want to be. So we still have bonds, they're shorter term bonds, but we've been able to reduce the exposure and go towards more equity style portfolios that have downside protection. And then last but not least, for some clients that are interested, because they're not for everybody, I'll always say this, but the fixed index annuity has been touted by the Schillers and the Mertens and the Moshe Moleskis of the world, very well known and respected economists, as a great bond alternative.
Right.
So we've also implemented that.
All right. John, this was really helpful. If somebody would like to talk to you more about those options or maybe those structured notes or have you take a closer look at their portfolio, what's the best way to reach you?
Yeah, you can give us a call at the office, 858-935-6210, or you can visit our website at www.gosecures.com. And under the contact us, you can go right to our calendar and schedule an appointment, or just give us a call and we'll schedule it for you.
Very easy. All right, John, thank you.
Thank you, Erin.